Okay, hello everyone, and welcome to this webinar brought to you by Trader's Log, and hopefully everyone can hear me and see my PowerPoint presentation as well. First of all, I'd like to give a big thanks to Dan Blystone and Trader's Log for inviting me to speak today. Now, today what I'm going to be doing is giving you an overview of how I approach trading the Forex market using range and swing trading methodology. I'm going to be giving you an overview of how I look at trading ranges and swings in the market, as well as provide you with a specific trading strategy, if you will, that is specifically geared towards trading ranges. Okay. Looks like you cannot hear me. If you can hear me, please let me know. Okay, I'm not sure what happened there. Hopefully you could all hear me. Okay. Okay, great. Once again, I would like to thank Dan Blystone and Trader's Log for inviting me to speak today. My name is James Chen. I'm the Director of Technical Research and Education at FXDD. Now, if you didn't hear me before, I would like to just today I'd like to give you an overview, a brief overview of how I approach trading the Forex market from a range and swing trading perspective, and then I'm going to be providing you with a specific strategy for using or for trading within these ranges and trading swings within the Forex market. I'm going to be showing you my charts, and also if we have time towards the end, I'd like to give you an overview of what I'm looking at specifically on each of the major currency pairs, as well as other instruments that I'm currently looking at. So hopefully everyone can hear me now and see my charts, and let's quickly move forward here. Okay. Okay, now before I get started, as I always do, I would like to give you a quick disclaimer. Forex trading is a high-risk activity, and I'll give you a few seconds to read through that, and then we can move forward. Okay, and since this is my first webinar here on Trader's Log, I've done many webinars before, but since this is my first on Trader's Log, and many of you may not be familiar with what I do or who I am, I would like to give you a brief overview of myself. But before that, once again, I will be talking about swing and range trading in the Forex market today. Okay, so very quickly about myself. My name again is James Chen. I am the Director of Technical Research and Education at FXDD. I've only been at FXDD for about a month and a half. Prior to that, I was at another Forex broker here in the U.S. Called FX Solutions, but currently I am at FXDD. And I've been an active Forex trader really since the inception of retail Forex, pretty much back since 2000, 2001, and I use primarily technical analysis. So some of you may have seen my analysis. It's pretty much all over the place in terms of besides on our website, it's also on at Trader's Log, as well as many other places online and in print. And once again, when I trade, I'm primarily trading from a technical analysis perspective. Prior to trading Forex, I was trading equities and futures as well. I'm a chartered market technician, or a CMT, which is a designation for technical analysts here in the U.S. and globally. That is designated by the Market Technicians Association right here in New York. And I am a registered commodity trading advisor, also registered here in the U.S. with the National Futures Association, or the NFA. I publish daily and intraday Forex technical analysis, as I mentioned, and you can find it on traderslog.com, as well as on fxdd.com and many other sites. I've also authored numerous articles in these publications that you see here, including Forbes.com, Futures Magazine, Technical Analysis of Stocks and Commodities Magazine, SFO Magazine, as well as many others. Now, last month I had an article in SFO Magazine that talks all about this particular strategy that I'm going to be presenting to you today. Now I see, hello Ivan, I'm looking at the questions here. Ivan is a regular at my webinars at FXDD, and you've probably, Ivan, you've probably heard this strategy that I'm going to be talking about, but if you bear with me, I'm going to show you some pretty good examples. So once again, SFO Magazine, last month's issue, if you could take a look at that, it's all about this particular strategy. I'm also quoted on a regular basis by Reuters News, Dow Jones, Associated Press, International Herald Tribune, as well as many others. And I am the author of 2 books, Essentials of Foreign Exchange Trading and Essentials of Technical Analysis for Financial Markets, both of which were published by John Wiley & Sons in the past couple of years. Also, I have a DVD set, High Probability Trend Following the Forex Market, that is published by FX Street. So that's basically an overview of who I am and what I do. Now let's get to the main part of this presentation. As always, as I always do on these webinars, if you have any questions at all, please feel free to type them in to the questions window. I'd be more than happy to answer any questions that I see pop up. Okay? So let's get started real quick. Okay, so today I'm going to be talking about range and swing trading. Essentially, I'm going to be talking about trading within ranges. And when I talk about ranges, and we've seen many ranges recently in different currency pairs. But when I talk about ranges, I'm talking about several different types of ranges. There, first of all, when you talk about ranges, most people are thinking about the horizontal ranges, the flat ranges, the sideways ranges, where price action bounces up and down between support and resistance, between the floor at support and the ceiling at resistance. So most people, when you talk about range trading, are thinking about that. Now, there are other types of ranges that I tend to call ranges, and I use this same methodology that I'm going to be showing you for these types of ranges as I do for horizontal ranges, with some changes, and I'll tell you exactly what they are and show you exactly what they are in a minute. But once again, there are 3 types of ranges. One is horizontal range. Another is, you could call it a parallel uptrend channel, and I would also consider that a type of range. And then the third kind is a parallel downtrend channel, and I would also consider that a type of range. So there are 3 types of ranges that we're looking at here that I like to use this methodology. Now, what is the emphasis here when you're swing trading or trading ranges? The emphasis is on trading swings or turns in the market. So that's what we're looking for. We're looking to trade long at support or near support and short near resistance or at resistance. Okay, so that's essentially the concept we're looking at. Okay, so how exactly do we do that? Well, first of all, I always stress this. Risk management is the most important aspect of your trading. And you may hear many people talk about it, but it is the absolute truth. Risk management is extremely important. Now, when you're trading turns in the market, when you're trading from a range trading perspective, setting your risk and money management is relatively straightforward. And I'm going to talk about that in a minute as well. It's a very active form of trading, as there are always range trading opportunities in currencies. And now, I've defined range trading using pretty broad strokes here, saying, whether it's a flat range or it's an uptrend range or a downtrend range. All of these types of ranges occur very often in the currency market. If you if you've ever traded or looked at a currency chart. Let me see here. I got a question. Lauren says, Dan did a webinar regarding moving averages, never received the replay. Okay, I think Dan can answer that question. Okay, so ranges occur very frequently in the Forex market. As I mentioned, horizontal ranges or angled ranges. Okay, and they can be used effectively on any currency pair. Now, when I say any currency pair, there are a few criteria I have there. First of all, I do like to or tend to trade currency pairs that are more liquid, which also means that they generally have tighter spreads. So that's why I'm primarily looking at the majors, which include euro dollar, dollar yen, dollar Swiss, and euro dollar, pound dollar, dollar yen, dollar Swiss. Those are the 4 considered majors. Okay. Now there are also what we call semi-majors, but they're pretty major as well. It's Aussie dollar and dollar Canada. Okay. Also, we have crosses, and the most important crosses being, for example, euro pound, euro yen, euro Swiss, pound yen, etc. So those are some of the most important crosses. Now, all these put together, and you could also trade exotics as well. These are the ones that are less liquid. However, I tend to trade more, once again, the more liquid pairs and the pairs that generally have the tighter spreads. So that's what I'm looking at. But generally speaking, you could find ranges on any type of currency chart. Now, the time frames are also very flexible. A lot of people ask me, what time frame am I trading? You're looking for ranges, or you're looking for trends. What time frame are you trading? Well, generally speaking, if you've ever heard me speak before, I am primarily, I'm looking at daily charts. Okay, daily charts, and I'm also looking at 4-hour charts and 1-hour charts. So that's sort of the span I'm looking at, and I rarely, if ever, go down to the very short-term charts, like the 5-minute chart or the 1-minute chart, although those are also very popular with many people. I just believe that there's a lot of noise on those charts. Now, when you talk about very short-term charts, I would generally tend to reserve the very short-term charts for my breakout trading strategies, as opposed to range trading strategies. Okay. Okay. Now, what are the criteria I use? And bear with me. There are several PowerPoint slides here, but I just want to be able to get as much information as I can out to you, and then I'm going to be looking at my charts and showing you exactly what I mean. Now, also, if you want a copy of these charts, you can always email me at jchen@fxdd.com. That's jchen@fxdd.com. I'd be more than happy to provide you with these slides. Okay, so what are my swing and range trading criteria? Number one, support and resistance levels, very obviously. Now, when you talk about support and resistance, what is support, what is resistance? Support can be considered a floor, resistance can be considered a ceiling. Now, you're looking, generally speaking, you're looking to go long. In a range trading situation, you're looking to go long near support and short near resistance. That's easier said than done, but I'm going to show you exactly what my approach is in a minute on the charts. So support and resistance levels is the most important thing. Number two, we've got intra-range trend lines. Intra-range trend lines are my way of getting into a range trade. Okay? Within a range, there are trend lines, and oftentimes these trend lines are very good triggers for getting into range trades. And once again, I'm going to show you exactly what I mean. Also, bar and candle patterns. I talk a lot about this. When I'm talking about bar and candle patterns, primarily what I'm looking at is I'm looking at reversal patterns that show me that, or give me confirmation or a warning that perhaps price action will turn up near support or turn down near resistance. And what are the most important candlestick patterns that I use? Well, they are the hammer and the shooting star. And those are the two most important ones that I use. There are also others like the doji, the bullish and bearish engulfing patterns, etc. But by far, the ones that I rely on the most are the hammer and the shooting star. I'll give you a visual depiction in a second. Also, I use what are called price oscillator divergences to give me a clue that perhaps price action will turn, or give me a warning that perhaps price action will turn. These are all coming together. All of these clues are coming together to give me what I call confluence. And what is confluence? Confluence is simply a coming together of different technical factors telling me that, yes, it looks like there might be an actual turn near support, turn up near support, or a turn down near resistance. Okay? And when several different factors are telling me, are confirming to me that this may very well be occurring, that for me constitutes a high probability trading opportunity. Okay? Now, number four, along with all this, is the oscillator. And not only can oscillators be used in divergences, and I could talk all day about divergences, but not only can an oscillator be used for that, it could be also used as a momentum indicator, showing me when price action is emerging from overbought or oversold. And that, for me, is yet another signal, yet another confluence signal, that perhaps this turn is taking place. Okay. Okay, now, you can also use Bollinger Bands or moving averages. Oftentimes, Bollinger Bands and moving averages can be used to denote potential turns in the market within a range within a range trading situation. Okay. Now I'm going to go through each of these one by one real quick, and then I'm going to show you on the charts. Okay. So these criteria. Okay, so number one, most important, is support and resistance levels. This is a very simple depiction of support and resistance. These are visually derived levels, which means all you have to do is look for past turns in the market, past pivots in the market. More than one, you've got a resistance level. If it's more than one acting as more than one point turning at around the same level, and the key word here is around. Okay, this is not an exact science. In terms of you're very rarely and almost never going to have price action turn at exactly to the pip at the same place. So therefore, we have an approximate level, but that's pretty close to me. Okay, so right here we have a resistance line. Resistance is the ceiling. Right down here we have a support line. Support being the floor. Okay, so we're looking for 2 or more turns to the downside from resistance, to the upside from support. Now this happens to be a flat or horizontal range. Again, we could also talk about parallel uptrend channels, parallel downtrend channels as types of ranges as well. Okay, for these purposes, for this purpose. Okay. Now number 2, intra-range trend lines. Now for those of you who do not know what this is, these are trend lines that occur within a range. Now, if you look at this chart right here, of course I would like to get in on the bottom right here, on the very bottom, this support line right here. However, that would mean that I'm picking tops and bottoms, which I'm not in the business of doing, and for me, it's just seems to be a losing game. Okay, and for many people as well. So if you're in the business of choosing tops and bottoms, you could have gone long on the bottom here. But then you very likely, were wrong about it. However, so what I'm looking to do here is I'm looking to get in on a break of an intra-range trend line. This is my trigger to get into a trade. Why do I use this trigger to get into a trade? Well, first of all, okay, so you've got this turn here that occurs at the bottom support, right? You've got that turn here. You've got this. Let's say you also have this hammer candle that is showing you that perhaps this turn is really taking place. Perhaps you also have price oscillator divergence telling you that this turn is taking place. Now, how do I get into the trade? I'm looking for the last element, which for me is momentum, telling me that that in fact this turn is taking place. And with these intra-range trend lines, a breakout of these intra-range trend lines is telling me that yes, momentum is on my side. Okay. Not only did the turn take place, but a momentum breakout occurred, and therefore I could be, pretty confident that this turn has taken place, and we're looking to the upside at this point. Okay. I could have very well also drawn, these. I'm sorry, the rising trend line. Okay. So within a horizontal range, there's no bias, long or short. Okay, so I'm looking to go long at the bottom, long near the bottom, short near the top. Okay, however, in an uptrend channel or an uptrend range, my bias is obviously to the upside because I'd like to follow the trend. So in an uptrend range, I'm looking only to go long near the bottom, long near support, and I'm not looking to go short near resistance. By the same token, you have a downtrend channel. The bias is to the downside. So I'm only going to be looking to go short near the top, short near resistance, and I'm not going to be looking to go long near the bottom, near support. Okay? So, and once again, the sideways or horizontal, as we can see here, there is no bias. So I could go long or short as I see fit. All right? Now, that being said, the uptrend range and the downtrend range. Although in an uptrend range, I'm only going long at the bottom, I can use the other side of the range, the top of the range, as a profit target, as one way to, to set my profit target. But I'm not going to be, once again, I'm not going to be going short at the top of an uptrend range. Okay, if that makes sense. Okay, so once again, we're looking for intra-range trend lines as our triggers to get into trades, and we're looking for breakouts. Bar and candle patterns, okay, and I talk about this a lot. Why do I talk about this a lot? Because over many, many years of trading Forex and other instruments, I've learned that hammer candles and shooting star candles have been extremely useful, not as primary trading tools, but as very good warnings or confirmations that a turn is taking place. What is a pin bar? What is a hammer and what is a shooting star? By the way, they're also called pin bars. If you only look at bar charts, they're also called pin bars or Pinocchio bars or whatever you want to call them. I don't really care what you call them. What really is important here is the shape of the candle. Okay, so if you take a look on the bottom here, we've got a down run. After this down run occurs, we've got what we call a hammer candle. Okay, so what is a hammer candle? Simply, we have a down run. This last candle is trying to move down. Okay, it's trying to continue the downtrend, but it's unable to. It's getting rejected near the lows. It's getting it's failing near the lows, and it comes all the way back up to close near the highs. A hammer is simply a small upper body and a long lower wick or lower shadow that follows a down run. Okay, very, very important. I would not take a trade based on a hammer candle alone. However, I will take a trade that is supported by a hammer candle. Okay, and it all contributes to my idea of confluence, a coming together of different technical factors telling me that perhaps there will be a turn. So, a down run, price action tries to move down, it gets rejected, moves back up, and that's if this occurs at support, at prior support, that for me is a strong signal that in fact a turn may be occurring. The same token, shooting star. What is a shooting star? Same thing, just opposite side. So you got an up run, and then you've got this third candle, or this last candle here, trying to move up, trying to continue this up run. It fails. It gets rejected near the highs. If this occurs at resistance, that means it's failing at resistance. Resistance is holding. Okay? So very, very important there. If resistance holds, price action comes down, it fails at resistance, then that's a possibility for a turn in the market. And that contributes to for me, a high probability trade when combined with other factors. Okay, so also you have multi-bar patterns like engulfing patterns and like the bearish bullish engulfing patterns, which I'm not going to go through today. You have double test failures, double, triple tops and bottoms. All of these patterns can contribute to your decision to go long or short in a range. Okay. Also, very importantly, we have what are called price oscillator divergences. And please bear with me. I'm giving you all this background information because it all pertains to the strategy that I'm going to be showing you in a second. Price oscillator divergences. What are they? I tend to use stochastics. Some people may use RSI, Relative Strength Index, MACD, MACD histogram, or what have you. But I tend to use stochastics. And how do I use stochastics to look for divergences in the market? Simply what I'm doing. And when I talk about divergences, most people think of what's called regular divergence, not what's called hidden divergence. So I'm primarily just going to be talking about regular divergence. And this, again, like the candle patterns, is simply a confirmation. I would not take a trade based upon a price oscillator divergence alone. I will take a trade because the price oscillator divergence is contributing to my decision to take that potentially high probability trading opportunity. Okay, so what is a price oscillator divergence? It's simply a divergence between price and the oscillator, a difference between price and the oscillator. It's a disagreement, if you will. So, and I'm going to say this quickly, and hopefully, some of you are, or most of you are familiar with what divergences are. But what a divergence is, for example, this is a regular divergence. If there's a higher high in price and there's a lower high in the oscillator, that's telling you that there's a loss of upside momentum and perhaps a turn in the market to the downside. Once again, if you have price making a higher high, higher peaks, and the oscillator is making lower peaks at the same places, then that's telling you there's a loss of upside momentum and a possible turn in the market. By the same token, if you have a lower low in price but a higher low in the oscillator, that's a disagreement that we're looking for price to correct. So once again, lower low in price, higher low in the oscillator. That talks about a loss of downside momentum and therefore a possible turn to the upside. Okay? And this, once again, contributes to my potential decision to get into a high probability trade. Okay, so those are the patterns that I'm looking at. Also, besides being used as for divergences, oscillators can also be used to talk about, emergence from overbought or oversold. I'll show you all this in a second. But stochastics, I tend to use stochastics. Now, the way a lot of people use these oscillators is that, let's say the oscillator goes into the overbought area. In the case of the stochastics, it's the above 80. If it goes above 80, it's an overbought. And a lot of people are saying, because it goes into above 80, that now it's time to sell because it's overbought. I say absolutely not. Okay. Other people, the same people will say if the oscillator goes down and it goes below 20, which is oversold. If it goes below 20, that means it's time to buy again because it's oversold. And I say absolutely not. That is not how I use oscillators, and you can see on any chart when the oscillator goes up into overbought, you could have a continuing trend, okay, that just continues on up, and the oscillator can stay in overbought continuously while you're still trying to go short, which obviously is a losing proposition. Same thing, if on a downtrend, you have a downtrend, the oscillator enters into oversold, down below 20. It could stay there for a long time while you're still trying to go long, and price action is still moving down. Okay, so once again, that's not how I use the oscillator. How do I use the oscillator? Oscillator is another confirmation that I'm looking for emergence from overbought or oversold. So let's say price action is, the oscillator's already in overbought, okay? I'm looking for a turn down to cross below the 80 line, below overbought, and that's telling me that perhaps, the momentum is going to the downside, and perhaps that turn that I just saw at resistance is actually taking place, okay? Same thing on the bottom, near support. If you have a support level, and then you have the oscillator that's already in oversold, below 20, and it crosses above the 20 area. That, for me, is just yet another confirmation that perhaps price is turning near support. Okay? So very, very important there. So, I'm looking for an emergence from overbought or oversold, not an entry into overbought or oversold. Now, when the oscillator is in the middle, between overbought and oversold, that, for me, I don't care about the oscillator. I'm not even looking at it. I'm looking at it for possibly for divergence purposes, but for any other momentum purposes, I don't care because it's not in overbought or oversold. At that point, it's not telling me a lot. Okay, that's the oscillator. Bollinger Bands also, you could use, within ranging situations, oftentimes Bollinger Bands will help confirm support and resistance in a sideways motion, but, Bollinger Bands were really sort of meant more for their trend following and volatility breakout type of uses as opposed to range trading. But they can also be used oftentimes to help support, your support and resistance lines. Okay, now I'm just going to talk about exits real quick, and then I'm going to get to the strategy, and then I'm going to get to the charts and show you exactly what I mean. Okay, so exits. What do we mean by when we talk about exits? Stop losses within a range trading situation are determined by price action. What does that mean? If you have a support and resistance level, what's the logical place, if you're going long near support, to place your stop loss? Well, obviously, it's right around support or right under support. And then if you're going short near resistance, where is a pretty obvious place to put your stop loss? It's right above resistance. Why? Because at those points, below support and above resistance, the market is telling you that your range trading approach right now is wrong. Okay? It's not in a range trading situation. The market is telling you you're wrong. So I place my stop losses where I'm thinking the market is telling me I'm wrong. Okay? So what I often do is I put a stop loss below the last swing low or below last swing high. Okay? Which is basically support and resistance. Okay, and you should consider your risk to reward to risk ratio. When you talk about range trading, it's pretty straightforward because you know where you're going to place your stop loss, and you know where your expected target, your approximate expected target might be, which is the other side of the range, and therefore you could set your reward to risk ratio in a positive manner. Okay, and oftentimes, how do you get out of a trade? Well, first of all, your ultimate target is the other side of the range. Okay, but in order to lock in your gains, oftentimes I will pull my stop loss to break even, and from there, if it continues to go in my direction, then I will often, trail my stop loss manually. Okay, so which is another form of pulling my stop to break even. But there, I'm progressively locking in more and more gains. Hopefully, and hopefully, price action will reach my target. Now. Like I mentioned, you identify support and resistance levels for profit targets, and alternatively, you can let the oscillator give you an exit signal as well. Okay, so when the oscillator moves to the other side of overbought or oversold, that's a possible exit signal as well. Okay. All right, so this is the strategy that I'd like to talk about. Let me first see if there are any questions here. Okay. Okay, Frank asks, what do you mean by 2 or more turns? Okay. I'm sorry, Frank. What do I mean by 2 or more turns? Okay, what I meant by that was that in order to draw a support level or a resistance level within a range, you need to have at least 2 turns where the price action turned. Okay, that's all I meant. You can't draw support. I mean, you can draw a support level, a horizontal support level or a resistance level with 1 turn, but preferably, when you're talking about range trading situation, preferably you have 2 turns at least. Okay. And up asks, for this intra range, which time frame do you use? Okay, I'm going to be showing you charts where I'm using the daily chart and the 4-hour chart. But like I said, the time frames are pretty flexible. I just tend to stay away from the very short-term charts. And the very short-term charts, if I ever use a very short-term chart, it's usually for breakout type of trading, not for this type of range trading. And up also asks, what parameters do you use to determine the trend to go long or short? Okay, that is actually a topic for a different time. Because I'm not really talking about trend following right now, but in terms of determining the trend, I'll just give you a quick answer. I have many ways to determine the trend when I'm using a trend following approach. Number 1, I'm using trend lines, okay, and that's probably my most important tool. Number 2, I'm using moving averages, and more specifically, I'm using multiple moving averages, okay. Not only am I using, for example, the 50, the 100, and the 200 period simple moving average, but oftentimes I will use 5 different moving averages, which show me that if they're not all crossed, if they're all separated and they're all moving in the same direction and they have the correct order of moving averages, being in an uptrend you have the longest period moving average on the bottom, followed progressively higher by shorter period moving averages. In a downtrend, you have the longest period moving average on top, followed progressively lower by shorter term moving averages. Then that's what's called correct order of moving averages, and that's one way that you could denote a trend or lack thereof. Okay, so to make the long story short, trend lines and moving averages is how I do it. Okay. Also ask, sometimes it crosses below 80 and then goes up and goes down and you're stopped out. Yeah, absolutely. But you know what? I think you're talking about the oscillator there. It goes up and goes down and all that. Yeah, absolutely. That's why the oscillator is only one confirming factor for me. Okay? One confirming factor. If that occurs, then you have to have your risk management in place. That's a part of trading, that you have to expect losses. But in terms of the oscillator doing that, I am not putting in my trade based upon the oscillator alone. Okay, great question there. I'm not going to be using the oscillator to get into a trade, only as confirmation of other factors. Okay. Frank asks, at what point do you move your stop to break even? Great question. And I could go into long detail about that, but basically, very basically, in a trend-following situation, when you get into a trend, okay, and price action hopefully moves in your direction, if it does, then what I'm generally speaking looking for is some type of consolidation or minor correction, and then after that occurs, I'm gonna be, and after that occurs, and then and price action hopefully continues in the direction of that trend, in the direction of your trade. At that point, I will be moving my stop loss to break even, and then from there, I'm looking for other consolidations to hopefully, move my stop loss even further up and up. If I'm going long, further higher and higher to lock in as many gains as I can, while still not, I'm very wary of the volatility in Forex markets, so I'm not having really, really tight stop losses, but I would like to, lock in my gains while still giving price action enough room to play out its volatility. Okay. Mulaji asks, what are parameters for each indicators, i.e. RSI? Okay, stochastics, I use 1433. RSI, I usually use 14. I mean, I've been using, especially in the case of stochastics, I've been using those settings for stochastics for a very, very long time. And it just happens to work for me, for how I use them, okay? Vladimir asks, how do you trade futures the same way as Forex? Essentially speaking, yes. For me, a chart is a chart. And, I don't even have to know what I'm, really, I don't have to know, and some people may disagree with this, but I don't really have to know what I'm trading. Because for me, as long as it's a liquid instrument, and as long as you have trader psychology working, then a chart, especially if you have your risk management in place, then a chart has the same types of phenomena across instruments. Okay, so here's a strategy: backdrop, warning, trigger. Okay, what is a backdrop, a warning, and a trigger? Very quickly, let me go through them. Okay, the backdrop. The backdrop is simply an environment or a condition. What are you looking for? What is, first of all, you're looking for to have something there that you could play with, that you could work with, okay? Now, the backdrop is a horizontal or an angled channel, okay? Some type of a range, okay? As I just explained to you, a range can be horizontal or it could be angled, as in a trend. So here, in this illustration here, we have an uptrend, okay? And that I would also call a range. Now, as I mentioned before, there's a bias to trend ranges, and I'll talk about that in a second. So the backdrop that you're looking for is some type of range or channel, okay? If you have that, then we can move to see if we have any what are called warnings, okay? But first of all, let me talk a little bit about the backdrop. Now, the backdrop in horizontal channel, as I mentioned, you look for turns to the downside near the top of the channel, okay? Imagine this was a horizontal channel. You look for turns to the downside from resistance, okay? And you also look for turns to the upside near the bottom of the channel, near support, okay? But in an uptrend channel, as I mentioned before, you look for turns only to the upside near the bottom of the channel. You could use, near the top of the channel as a profit target, but I would not advise going short at the top of an uptrend channel, only because that would be a counter trend play. That would be a counter trend type of a trade. Okay, and I'm not really, I don't really like to make counter trend trades. Okay, so once again, you got to turn near the bottom in an uptrend. You're going to go long there, but you're not necessarily going to go short at the top. Same thing with the downtrend channel. In a downtrend channel, the bias is to the downside. So you will be looking for turns to the downside near the top of the channel or near resistance, but you're not necessarily going to be looking for long opportunities near the bottom. Okay? Okay, so that's a backdrop, some kind of a horizontal or angled channel. Once you have your backdrop, what do? You look for one of three warnings. Once again, this is one of three warnings, okay? The first type of warning is the reversal candle pattern. And as I mentioned, before, the ones I like the most are hammer candles and shooting star candles, sometimes doji candles, sometimes engulfing patterns. But as we can see in this illustration here, we have a reversal candle pattern here. Okay, it doesn't reverse right away. Okay, it's not to say it reverses right away, but because I'm not getting into this trade yet. Okay, there's a down run, and then you got this little body, upper body, long lower wick. It occurs right at this uptrend line. Okay, so that's a warning. That's just a warning. I'm not getting in just because it's just a warning. Another warning is, as I mentioned, price oscillator divergence. I'll show this on the charts in a second. Higher high coupled with a lower high is a possible, a higher high in price coupled with a lower high in the oscillator is a possibility for a turn to the downside. A lower low in price coupled with a higher low in the oscillator is a possibility for a turn up in price. Okay, so that's the second warning. The second possible warning. Third possible warning is the oscillator cross of overbought or oversold. If you could take a look here, we have a cross here. We have price action. I'm sorry, we have the oscillator in oversold. It crosses to the upside. That for me is one of the warnings. Okay, so 3 warnings. Look for one of these 3 potential warnings: reversal candle pattern, and or price oscillator divergence, and or oscillator cross of overbought or oversold. Okay, now once you have one or more of these 3 warnings, now one is fine, but preferably you have more than one of these 3 warnings. You go to the trigger, and the trigger gets you into the trade. Now, how do you get into a trade? The trade entry is triggered on a simple breakout play. Typically, the breakout would violate an intra-channel or intra-range trend line. So as we can see here, we have this down trend line right here. This is within this range. Okay. In this case, it's an uptrend channel or uptrend range, and we have a counter trend line. Okay, that means a trend line that goes against the trend. Okay, so that's what I'm looking to play breaks up. Now, once again, what is this telling me? It's telling me not only did a turn occur right at the bottom of this channel, not only is the oscillator confirming it, not only is there divergence that is also confirming it, but also I've got momentum, and this momentum is on this breakout right here. Okay, so I've got this breakout play, a break to the upside. That's the trigger. That's telling me momentum is going in the direction of in my favor. So I'd like to possibly get into this trade. Okay, put it all together. I'm going to show you my charts right now. Okay, this methodology for range and swing trading puts in place several criteria for setting up a high probability trading opportunity. You require a backdrop, a warning, and a trigger before entering into trade, and this increases the potential for success in range and swing trading. Now, what do I mean by this? If you require all of this before you take a trade, that to me is a good thing, because that to me is saying that you are being selective about your trades. You're not taking any any trading opportunity that comes your way. You are being selective about your trades. Everything has to line up for you before you take that trade. It's a prudent way to trade. It's a smart way to trade. And we as retail Forex traders do not have the luxury not to trade if we so choose. Okay, and that is a good thing. So if you have requirements in place that say, you know what, if this doesn't occur, and this doesn't occur, and this doesn't occur, I'm not going to get into a trade. I'd rather not waste my money here. I'd rather not, I'm rather wait for something good to occur, something that really lines up with my trading strategy. Okay, so that's how you put it all together. Let's go to the charts. Okay. Okay, if you all bear with me for a second. Okay, let me just see if there are any questions here. Okay, Vladimir asks, would you please share some secrets, what you discovered during many years of trading? Thank you. Basically that's what I do, Vladimir, on a daily basis in my webinars. You could come to fxdd.com and sign up for one of my webinars that I do on a weekly basis. Basically what I'm doing is I'm trying to share with you my views and my outlook on how to trade Forex, which I've been doing for a long time. So that's basically what I do in my webinars, including this one right here. Anup asked, for long-term trend identification, is weekly chart useful? Yeah, it can be useful, but I tend to use the daily chart more. okay, for both for trend, determining the trend as well as for trading purposes. Anup asks, do you also consider money flow and volume indicators? I'm not sure what you mean by money flow, but volume indicators, it's hard to have volume in the Forex market, in the spot Forex market, because of the fact that it's a very decentralized type of exchange. So you don't have market-wide volume. So no, I tend to look at price action mostly. Okay. Okay, great question, sir. Oh, okay. The Chaikin indicator. No, I don't use that. I don't use that. Okay. So if you take a look at my charts here, this is the strategy that I'd like to show you. First of all, you've got a backdrop. Number one is you got a backdrop. I mean, you've got this parallel uptrend channel. Okay, this is, to me, it's an uptrend range. Okay, now once you have the backdrop, what do? You take a look for warnings. Here we have a great warning here. After this down run, okay, so it moves up, and then moves down, moves up, moves down. Now it's at the bottom of this channel again. Now it's got this this little hammer candle right here. Small upper body, long lower wick after a down run. That's a key chart pattern right there. Right there. Now, what does that mean? It got rejected right at support. This is a beautiful example right here. It got rejected right at support. Does that mean it's going to turn up right away? In this case, no. But hopefully the case, I mean, if it did turn up right away, that would be the best thing. But it doesn't here. So anyway, though, I'm not getting to the trade yet. This is just a warning. I've got a hammer candle right here. Okay. But not only that, a few bars later, I have the stochastics cross up above oversold. Okay. Once again, I'm looking for emergence from oversold or emergence from overbought. Right now, I see the emergence up from oversold, a cross above oversold. Okay, so I've got two signals here, two warnings, if you will. Okay, I don't have any divergence here, but I have two warnings here, two of my three warnings. Now what do? I'm looking for a trigger to get into the trade. What's my trigger? Simply, I've got a counter trend line right here. Okay, now after the warnings took place, I have a way to get in on momentum break. Okay, so which was very, very good in this case because it allowed me to wait while this sort of consolidation took place. So I'm not only looking for the warnings of a turn, I'm looking for momentum in my direction, which is represented by this break to the upside. Okay, so that's a very good example right there. Let me show you another one. Oops. Okay. This is pound dollar. This is an hourly chart, okay, pound dollar. Now, here we see, very good resistance right here, if you take a look. Very good resistance here, okay. Now, I'm using the top of the wicks, or the top of the shadows, as you can see here. Very good resistance. Okay, now, you've got the backdrop for a possible downtrend range, okay, or downtrend channel. Now, you're looking for warnings. What do you have here? You have price action move up to the top, and it ends in this shooting star pattern. Shooting star being a small lower body, long upper wick, right at resistance. Okay. Now, what do you also have here? This is actually called hidden divergence. Okay, and I really don't want to go into that if you're not aware of that what that is. It's a little bit more rare, and it's a little bit more complicated. But basically, what it's saying is if you have lower highs in the price and higher highs in the oscillator, that's called hidden divergence and a possibility for a continuation of the downtrend. Okay, but I've got some divergence there. It's not the kind of divergence that I'm really talking about, that I was talking about before, but there's some divergence there. I've got this candle here, and then what do? I go to the next one, and this is not a great trend line. Okay, intra-range trend line. It's not a great one. This is a very short time frame, not a great one, but one nonetheless, and you have a break to the downside and a possibility for a move to the downside. Let me show you another one. Okay, this is a good one. This is pound yen hourly chart. First of all, you got good resistance in a sort of a down trend channel. Okay, good resistance there. What do you do then? You look for some type of a warning. Now, this warning here is I've got this. It's not a great shooting star, but it's a, it's sort of a smaller lower body, longer upper wick. Not the best one. However, this occurs right at resistance, right at downtrend resistance. Okay, and then we've got the oscillator move down. Okay, a move down, cross below, overbought, and then once that happens, you look for a trigger to get in. And in this case, we have this uptrend support line. Excuse me. This uptrend support line, this intra-range trend line, break to the downside, is telling me momentum is taking place on this, on this breakdown. Okay. Okay. Now this is a sideways one. Okay. Now a lot of you may notice. What chart this is. This is a Euro-dollar daily chart from back in the day. But it just shows. I chose this one. It's a very old chart. It's it's when price action hit its all-time high. It's a very old chart, but the reason I chose it is because it's a very, very, very good example. Now you take a look here. You got the backdrop, a sideways channel. We got very good support here. We got good resistance at the all-time high up here. Okay. Now once you see that, now if you take a look here, this is regular divergence. Higher high in price, lower high in the oscillator. What does that talk about? That talks about loss of upside momentum, okay? Loss of upside momentum, disagreement between price and oscillator, divergence. Price should correct that disagreement by going down, okay? So higher high in price, lower high in the oscillator, loss of upside momentum. This occurs right at very significant resistance, all-time high right here, very significant resistance. We also have the oscillator move down here, cross below here. It also occurred here too, but we have it here. It moved down, and then what do we have here? We had a very nice candle with a long upper wick, a little, sort of a doji type of shooting star there. This, once again, most important thing is that it occurs right at very strong resistance. So you got those warnings. Now what do? You look for a trigger to get in, and you've got this uptrend line, intra-range uptrend line, break to the downside, and you could target the other side of the channel, the bottom side of the channel for that type of a trade. This is a daily chart of Euro-dollar. Okay, just to illustrate how this works. Okay. Last one I want to show you is dollar Canada. Dollar Canada, we've got this range here, sideways range, good resistance, good support. And then you look for some type of warning. You've got sort of you got a warning here. We got a move down, a cross down below over bought here, cross below 80 on the stochastics. This occurs right at resistance with not a great candle there, but we got this this one very good cross below right at resistance. And what do we do then? We look for a trigger for momentum, a breakout trigger. And here we have it. We've got this uptrend line here, break to the downside, and a possibility for a targeting of the other side of the channel, or the other side of the range, which is the bottom right here. Okay, let me take a look. Okay, I only have like 5 minutes left. I wanted to show you what I'm looking at on the charts right now. Just some interesting things that we could take a look at. Okay, this is a Euro-dollar daily chart, and we're still in an uptrend here. Price action broke down below this this triangle here. We broke to the downside. On that breakdown of that triangle, I was looking for 140. We hit 140, and then on a breakdown below that, I was looking for 137.50, and it was shy of 137.50. And then it popped back up. This is a daily chart of Euro-dollar. It popped back up to hit resistance up here at 142.50 or 142.80, which is right near the 100-period simple moving average. But I'm looking for more downside on Euro-dollar. Okay, more of a downside correction. I'm looking for another break below 140 for a possibility for yet another targeting 137.50. But not a lot of consolidation on Euro-dollar. Not a lot of great opportunities there. Dollar yen. If you caught this breakdown below this channel here, if you caught this breakdown, you were in very good shape. I was talking about a breakdown, right about over here. Okay, I was talking about if price action broke down, and it didn't yet. This is a 4-hour chart of dollar yen. It didn't break down yet, but right over here, let me show you a little clearly. little more clearly here. Right around here, I was looking for a breakdown. So what happened was there was a little pop, but then it broke to the downside, okay? And I was looking to target this last low at around 79.50, okay? So what happens, it hits 79.50. Now, a breakdown below there I'm looking for further downside. Why 79.50, first of all? Why was that my target? Well, very clearly here, we have this last low back in May at 79.50, and also we have the Fibonacci extensions here. Fibonacci extension at 161.8%, which coincides with the 79.50 area. And I always talk about confluence. Not only is it a prior support level, 79.50, but it's also a 161.8% Fibonacci level, and therefore it's generally speaking, a good target if there was a breakdown below this channel here. And there was. So that was a good target to the downside. And right now we're in consolidation. But further downside, I'm looking for a possibility for a revisit of, actually 76.50, which, it's hard to say if that's actually going to occur, but I'm looking for a breakdown below the 261.8%, which is at around 78.30 area, and looking for a possibility of 76.50 if that, if the bearishness continues. Let me take a look. Very interestingly on dollar Swiss, we've got this very technical downtrend here, where price action keeps moving down, breaking down below successive all-time lows, and right now, just yesterday we just hit another all-time low, okay, on dollar Swiss. I'm looking to target, and if you take a look at this, I think I've run out of time here, but if you take a look at this, very clear technicals on dollar Swiss, and it keeps moving down, and then after it moves down and breaks to new all-time lows, it pops back up right at resistance, which is prior support, and as we can see here, really good technicals here, and we just broke down again below the new all-time low. Now we're at yet another all-time low, and we're targeting 80 to the downside. Okay, so 80 to the downside after this 161.8% Fibonacci. In uncharted territories, like we are in now, in terms of targeting, oftentimes you will need to use such tools as Fibonacci extensions because you have no prior price action to rely upon. Okay, so you're using Fibonacci extensions in that case. Okay, let's see if there are any more questions here. And up asks, can we have some live recent examples, maybe last 1 to 2 days? Well, I was trying to give you my outlook. I mean, webinars are necessarily pretty limited, but once again, I do give my outlook every week here at FXDD. I have a webinar called Charting the Majors, so you can please feel free to take a look at that, and I'll show you many examples of things going on in the markets. Ian asks, with a horizontal channel, how do you decide to go short or long, or can one do both? Yeah, absolutely, Ian. Great question. In a horizontal channel, as I mentioned, there is no bias to the upside or to the downside. So if price action goes to support, then I'm looking for possible opportunities to go long there. If it goes to resistance, I'm looking at possible opportunities to go short there. Okay? So there is no bias, once again. Lauren asks, will there be a replay? I'm not sure. Trader's Log may have a replay. You might want to ask Dan here. Okay, great. So I think that's about it. And once again, I would like to thank Dan Blystone and Trader's Log for inviting me today. Hopefully there is a recording that you can take a look at. If you have any questions regarding today's webinar, please feel free to email me at jchen@fxdd.com. Once again, that's jchen@fxdd.com. And I would like to thank everyone very much for your time today, and please do feel free to contact me. Thank you very much.